Hello and welcome to Fund to Money. Here we will discuss how international funds can help you in the current equity market scenario to manage risks from volatility and also help you keep gaining from equity investments. Equity investments made abroad across the globe and take advantage of equity opportunities across the globe and effectively deal with some of the risks that are emerging, especially volatility in Indian equity markets, and also do it smartly thanks to investment expertise of fund managers who are experts in managing risks and spotting international investment opportunities, how you can take advantage of these opportunities that are emerging across the world, and how this is a great time for you to diversify just in case you haven't had enough of investing in equities and you want to still invest more. We say this because ideally, when markets are running up so well and so swiftly, you should be looking at other asset classes, say debt, gold, etc., and try to rebalance your portfolio. But just in case you want to invest more, you want to do a little bit of rebalancing even in your equity investment, and you want to rotate your equity portion a little bit, you can consider international funds. So what we are going to do is we're going to first talk about the advantages of international funds, some of the things that you need to keep in mind when you are buying international funds, and some of the risks and some of the key strategies that you should be looking when you are looking at international funds. Remember, it's not just for anything. We're talking about managing risk, diversifying your investment portfolio in mutual funds, and gaining from the emerging sort of opportunities in international markets. That's what international funds normally do, but now it's probably a very opportune time for you to consider it. So we'll be coming back shortly with the details. Don't go away. Welcome back. Welcome to Fund to Money. We are discussing international funds and how they can be really useful to you right now when the markets are getting a little choppy. Markets have run up for quite some time. There's apprehension in some corners about market correction, and international funds could be a great way for you just in case you want to invest even more in equities, so you can get these opportunities which are emerging not in India but elsewhere across the globe. You want to rotate the equity portion of your investment portfolio, and you want to rejig it so that you tap some more of the investment opportunities that are emerging across the globe. So let's first talk about the advantages, then we'll talk about the risks and the types of international funds, and we'll talk about the broad strategy. So one of the advantages, of course, is that you don't the risks in geographical markets. When you invest in lots of other markets, what happens is while one economy might be going up, doing well, the other economy may not be doing so well. So what happens is, while Indian domestic equities are expected to do well, India is supposed to do well, just in case for a plan B, you can go for another market or other markets, and you can concentrate, look at them, and get their benefits of their growth as well, right? So just in case there is a blip or a temporary period when things don't go so well in India, then you actually have an investment going which is helping you get the most of equity markets somewhere else in a growth economy, or an economy that's doing well. So uncorrelated risks. So that's number one. So that's the key for diversification and managing your risk. Then of course, market cycles, you also get less affected. So suppose in an industry there's a impact on because of some reason. So it could be say a cement or a steel kind of a cyclical sort of an area, sectors, or some other sector. For some reason it gets impacted, and your most of the fund managers have invested in stocks in that sector, so you don't get affected by it, because you already have another investment in your portfolio which is already looking at investment outside. So it counterbalances any adverse impact of a market cycle within India. So that's something that happens. Of course, there is investment expertise that you get from fund managers, which also helps you. If you want to do it yourself, it's going to take you a lot of time. You may not have the time and expertise. Now here you have that all, and at a very, very manageable cost. The other thing is, of course, what it also does is it sort of helps you not get affected by any adverse developments on the currency, which is, we're talking about the rupee. So just in case the rupee depreciates quite a bit, say because of oil price pressure, etc., the imports in turn become more expensive. Imports become more expensive, and because of that, there is the input costs go up. There's a pressure on profitability, etc. So what happens is all those stocks get affected. So if you have investments in those stocks via mutual funds, then your portfolio is going to get impacted. Now, what's going to happen is, if you're invested abroad in an international fund, that impact is getting counterbalanced. Number two, of course, is if there's an appreciation, say, of the rupee, then say where exports are happening, say IT sector does it, services, and you have got mutual fund investments where they have invested in those IT stocks, then you get impacted by it. What happens is, when you're doing an international by an international fund, if you're making gains out there, any adverse development like this gets counterbalanced. If you're not doing so well here, you're doing well because of that investment, right? What it also does is, if it's a nicely diversified international fund, then you're getting the benefits of growth in a large number of countries and a large number of sectors, right? So ideally, that is the kind of international fund that you should be looking at. That brings us to the various categories of international funds, and as we mentioned, that there would be international funds which will be looking at a particular country, it will be looking at a particular sector, it will be looking at a particular region, and it could be looking at a particular sector. So there are all kinds of international funds, but the international funds that we would recommend should be those which are widely investing across the globe, across a large number of economies which are growing well, across sectors, because that's your idea, is to diversify your risk at this moment, and therefore that is the objective we are looking at. In any other time, any other time period, you could be looking at something else. But if risk management or diversification is the objective, and getting growth from equities from other countries is the objective, this is what you should be looking at. And apart from that, of course, there could be feeder funds, which they're collecting money from people like you and others in India, and they're actually investing in another fund, which is again going and investing, making investments across the globe, or in a particular country, or a sector in a particular region or a country. So depending on how it's going, there could be another variation where there's a domestic equity fund, but it has got a very significant investment in international equity. So what ideally we would recommend is, if it's a pure international fund, then it should be diversified across countries, regions, and industries. It should be very well diversified. That should be ideally the one. Then you could, if that is not what you're looking at, you could even look at domestic equities, a fund which is essentially a domestic equity fund, but it's got a significant investment in international equities. So these are some of the broad categories that international funds that are available. Now, when you're looking at this, there are a couple of risks that are involved in international funds. You need to look at them. When you're looking at a national fund, you need to check out the offer document or the scheme information document. You'll find it in the mutual fund website or in the SEBI website. You can check them out. Check for the riskometer, check for the risks that are mentioned, so you can find that out. But there are some risks which are going to be there. Number one is the risk related to the economy. So in any particular area, if it's focusing or if it's across the globe or in a particular region, so if the economy is not going to be doing well, one of the reasons why you are investing, that is not going to be working. So that in any case, like India, that risk is always going to be there. There's going to be a political risk. So there will be countries which are growing well, but they suddenly get impacted by political development. So if say South Korea would obviously get impacted with any kind of development that's happening in its region. If the trade dispute happens, certain countries can get impacted. Domestic troubles, governments becoming unpopular. So those things are come into play. So in international funds, political situations in different countries where the investments are happening, they are of great significance, right? Then of course depends on how concentrated the whole thing is. We have already mentioned it. With just one country, one particular sector, or more narrow the scope, higher the risk it would be. But you can always check it out from the offer document. So the key part is, what is the kind of risk that you're taking? You need to know about it, right? Apart from that, of course, there's going to be the currency risk. A particular country or a region its currency doesn't do well, or the currency that's being used is not doing well, then of course it will have an impact on the companies out there, and it's going to make an impact on the kind of return. And of course, there could be a risk in the market. Suddenly there is something that happens, a development that happens, economic or any other development, suddenly the market gets choppy, people get nervous in that market, so you get impacted by it. In larger markets, if it happens, then of course it's going to impact you, right? So these are some of the risks. Now, when you are actually investing, so what you need to keep in mind is, it should be very well diversified, because you're trying to manage risk, you're trying to diversify. It should be across sectors, across countries. The other key part is the taxation. So if we mention a variant where it's largely domestic equities where investments are happening, and there's a certain proportion that is being invested internationally. Now, if it's 65% in domestic equities, then it will be treated like an equity fund. So all the rules apply. So for short term, 15%, which is 1 year, less than 1 year, 15% short term capital gains tax on capital gains you make. For more than 1 year, it's 1 lakh, more than 1 lakh capital gains you make for any investment more than 1 year. More than 1 lakh capital gains, you get taxed at 10% long-term capital gains tax you have to pay. So that is the treatment. Just in case that is not happening, which typically happens in most international funds, because they are typically not investing 65% in domestic equities, they are treated as debt funds, right? So therefore it's so important that's why the diversification becomes important. That's why it's also important that you invest for a longer period of time. So not only you have to be diversified across regions and sectors, you also need to invest for a longer period of time, simply because it's going to be treated like a debt fund if 65 is less than 65% is getting invested in domestic securities. Why? Because under 3 years in a debt fund, it will be taxed, the capital gains will be taxed at your income tax rate. For more than 3 years, you know it, if you have been following us, that the cost of units are going to get inflation indexation benefits, and then this elevated sort of cost will be used to calculate lower taxable sort of capital gains, and you pay 20% long-term capital gains tax. So clearly, this cannot be a short-term sort of investment. You have to look at a 3-year horizon. And the other important part is, because Indian equities are expected to keep growing very well, they would be having their ups and downs here and there. Therefore, not more than 10 to 15% should be in international funds, right? So these are some of the things that you need to keep in mind when you're looking at international funds, especially at this moment when you would want to manage the risk, contain the risk, and also get upsides from equity investments across the globe, right? So we hope you found this useful. If you've liked it, hit the like button, share it with others. Till the next time, take very good care of yourself, and goodbye.